Welcome, everyone, and thank you for joining us today for our Capital Raiser program. In this session, we're going to walk through some of the most important elements of our investment structure, specifically how equity is shared, okay, what fees look like, and how our promote structure is designed. By the end, you'll have a clear understanding of how these components work together to create a win-win for both our investors and our partners. So we're excited to share this with you. So let's go ahead and dive right on in. First, let's start off with understanding the GPLP splits that range from a 30/70 split to a 10/90 split, depending on the deal structure. Now, the split range of 30/70 to 10/90, that's going to represent the fund's standard parameters. Okay. However, the actual allocation may vary from fund to fund. And I'll explain that as we get through at the discretion of the managing partners. Now, depending on the deal structure, the investment terms, and market conditions, understand this: the final allocations will be specified in the governing documents for each fund before you even go out and present them and share it with an investor or move forward yourself with the fund itself. Okay, here's the fund structure overview. This is going to show a visual representation, a broad representation of the GP's allocation and how we are built out. You, as a capital raiser, are one of the most important parts of the fund. You will see here with 40%. So the GPLP split is, let's say it's a 30/70 split. Okay, the GP gets 30% of the entire limited partnership. Well, in this 30%, if we broke this and zoomed in to a 100% view, this is kind of sort of what it looks like. Now, this also changes from time to time. Okay, this is our GP allocation, where 30% of income will go to the asset management team. We got a acquisition and deal finding team that's doing due diligence and underwriting as well here. And then capital raisers are allocated for 40% of the fund. You guys are very important. You guys, these deals don't happen without capital. Therefore, 40% of the fund is allocated towards capital raisers. Now, GP equity allocation, let's talk about that. The GP equity allocation percentage outlined on the prior slide represents the typical structure for the fund. These percentages may vary from fund to fund at the discretion of the managing partners, depending on the deal size, complexity, and strategic requirements. Final allocation will be confirmed in the fund's governing documents prior to closing. Again, all this information you're going to know before you even move forward on the deal. One thing to know, though, let me go back, is this 40% is most likely to stay the same no matter what. This over here, really, it's good for you to know, but it doesn't matter. It's more internal for our internal team on fund to fund. So this is more for our underwriters and our acquisition and deal finders and our asset managers to know what they're going to get paid. If you are not a part of our asset management team or our acquisition deal finding team or our underwriting due diligence team, then you will not need to worry about these percentages ever, really. Capital raising for the foreseeable future will remain at 40%. So this is all you really need to focus on too, is as a capital raiser, you will earn equity in this 40%, and we'll show you how throughout this presentation. So here's the path to GP equity for capital raisers. You will earn an introduction fee for every investor you refer to us. Okay. But once the total raised capital exceeds 500,000 from you, you qualify for GP equity ownership. So we start at the top of the funnel, which is always introductions. As investors accumulate and you hit 500,000 in investments raised, that's where you get to earn GP equity, and that's going to look pro rata to what you bring to the fund. Let's dive a little bit deeper into what that looks like. Here's the allocation formula. It's basic math, so we'll go over this. Let's go ahead and take a look at the capital raise. Let's say you, as an individual, you come in and you raise $650,000. Okay. Now we're going to divide that by the total capital raised. Let's say the whole entire fund, the group, for this specific asset we're buying, raised $5 million, but you came in at 650. So 650,000 divided by 5 million is 13% of the total raise. Okay. We take this 13% because that's what you raised, and we're going to multiply that by 40%, which is the capital raiser's equity, right? So your GP equity then at this point would be 5.2% equity in the entire general partnership. Okay. That's the 30/70 split that we have. The 30%, you would own 5.2% of that entire 100% of that 30%. Okay. Let's talk about acquisition fees as we go in. Okay. The fund charges an acquisition fee ranging from 2% to 4% of the raise amount. Now, the acquisition fee range of 2 to 4% reflects the fund's again standard structure. However, the exact percentage may vary from fund to fund at the discretion of the managing partners based on the transaction size, deal complexity, and market conditions. Final fee structures will be set forth in the definitive agreement for each specific fund. Let's break this down. Okay. We charge, if we go to raise $1 million, we charge a 2% acquisition fee. That's $20,000. Okay. That's for the due diligence and the underwriting and the deal finding, all the work that we did to put together this deal. It might take us 1 month, 2 months, 3 months to put this whole entire project together for our investors just to wire transfer 100,000. So all the work that we didn't get paid for 3 months to make this deal work, that's where the acquisition fee comes in. Okay. And so we charge anywhere from 2 to 4% for that. Now, let's talk about how that fee is split amongst us. Let's go with the range here as a new capital raiser. Okay. If you are a brand new capital raiser with multifamily locker room and any of our funds, you will earn 0.5% of the capital raised. So you go raise $1 million, whatever 0.5% is of that, that is your compensation as a finder's fee, as an introduction fee. Okay. Now, for experienced capital raisers, you will earn 1% of the capital raised up to $1 million. Okay. Anything above $1 million, anything over $1 million, you get to keep 100% of the acquisition fee on the fund. So if we're charging a 3% acquisition fee, you'll earn 1% up to $1 million. But let's say you raise $2 million, that means you'll earn 100% of the 2% in excess above the $1 million. Okay. So keep it very simple, very straightforward. Now let's go ahead and make sure that capital raiser classifications to ensure clarity and consistency in compensation. The fund distinguishes between 2 categories of capital raisers, right? A new capital raiser, defined as an individual or an entity that has not previously raised capital with the fund. Okay. If you have not raised capital with us, you are new. That is your test trial, right? That you one and done. You could do one deal with us and you move forward as an experienced capital raiser moving forward. Now, an experienced capital raiser, defined as an individual or entity that has either successfully raised and closed on a minimum of $1 million in previous deals with the fund, or demonstrates a proven track record of capital raising. And this is going to be subject to the managing partner's approval. Okay. So it doesn't mean just because you haven't raised $1 million, maybe you've only raised 500,000 or maybe only 400,000 on other deals outside of our funds with other teams. That's fine. Have the conversation with our managing partners, right? And get that approval to become an experienced capital raiser with us. Okay, then there's what's called the promote. Let's go ahead and define what the promote is so you guys are aware if that's the first time you're hearing it. The definition of the promote is the GP's upside share of profit for delivering strong returns. We're back to the same formula here. If you take the capital raised, divided by the total capital raised, right? Your capital raised, divided by the entire fund, and multiply that by 40%, that's what you're going to get, okay, in equity. Now, here's the difference when it comes to the promote structure on what we have structured with our fund. For new capital raisers, the fund is going to retain 20% of the promote. Okay. So let's say on the promote, you earned $10,000. Well, you will get paid $8,000 of that promote, and the fund will retain $2,000 of that promote. Okay. And the reason being for that is because of the smooth transition that we have in place for all of our capital raisers to come in and simply just raise capital. Okay. We're taking care of all the legalities that go into this, the subscription documents, the investor portal, the blue sky filings, K1 reports, deal finding, due diligence, underwriting, everything that goes into this deal to be ready for you just to share the marketing materials with your investors, pique their interest, get them to wire funds. Okay. Now, for experienced capital raisers, the fund will retain 10% of the promote. So here's some capital raising benefits with a multifamily locker room. Introduction fee raised on capital. Okay. It's going to be pro rata GP equity once 500K is reached. That way it's fair across the whole 40%. Long-term promote participation, potential acquisition fee retention, and ownership in the GP with long-term upside. Okay. Let's go ahead and talk about distribution rights. So holding GP equity provides long-term participation in the economic performance of the fund. What does that mean? GP equity entitles the capital raiser to share, to a share of ongoing cash flow distributions, refinancing proceeds, and sell profits proportionate to their GP equity percentage. Okay. So you guys aren't just raising capital and done. You guys own equity in the fund based on what your GP equity percentage is, right? All distributions are subject to the fund's waterfall structure, which prioritizes returns of capital and preferred returns to the limited partners before the GP distributions are made. Okay, so for example, if we are paying our investors a 7% preferred return, and let's say on year 1 and 2, we do a 4%, well, then we're not getting paid on our waterfall structure until our limited partners are paid up their 7%. Okay. So I like this. I call this the put your money where your mouth is equity structure, right? This encourages us as a fund to find the best deals. And the only way for us to get paid is if our investors get paid their returns first, and then we get paid on excess profit. GP equity ownership continues for the life of the fund, providing alignment of interest and long-term upside potential. Okay. And what we do is we build what's called a single asset fund, meaning the lifetime of a fund is from the purchase of an entity to the selling of an entity. And if we decide to cash out, refinance, and stay partners in the entity of the property, then we will have lifetime access to cash flow from that property, assuming we stay in the deal on a cash out refinance. Or if we sell the property, then that's where the fund ends. Right? The sale of the property, we get all the distributions out, we roll it over into a brand new single asset fund on the next deal that we are acquiring. Okay, now to avoid confusion, it's important to distinguish between cash compensation and equity ownership. Introduction fees and acquisition fees are considered cash compensation paid at the time of closing, or as otherwise specified by the fund. GP equity allocation represents ownership in the fund and provides long-term participation in distributions, refinancing proceeds, and sell profits. Okay. Cash fees are separate from GP equity ownership and do not reduce, they won't replace or offset any GP equity allocation earned. All of that is built into the fund model before we even raise capital. Okay. It does not affect your equity. Now, to ensure clarity and protect the interest of the fund, all terms and participation rights are subject to the discretion of the managing partners. So final approval, all GP equity allocation, fee structures, and capital raiser participation are subject to the final approval by the managing partners. Governing documents, so the definitive terms for each fund will be set forth in the fund's governing agreements, which take precedence over any prior materials or communication. Right. So that means if we're discussing emails back and forth on what the fund's going to look like, right, everything's going to be final in the governing documents. Flexibility. So managing partners may adjust allocation, fees, or classifications to adjust fund specific requirements, market conditions, or strategic consideration. Okay. And here's our disclaimer, guys. This overview is for informational purposes only and does not constitute an offer to sell or solicitation to buy securities. participation subject to applicable securities laws and fund agreements. Thank you guys for participating, watching this fund overview. Hopefully that gives you a lot of information on how to participate in a capital raiser, a part of our program. If you have any questions, please email us at connect@multifamilylockerroom.com or reach out to whoever introduced you to the community so that way we could get your questions fully answered.